All right, Nancy, why don't you start, please?
Okay. So good evening, everybody, and welcome. My name is Nancy Gurdon, and I chair the 757 Angels. We are very, very happy to have you here with us this evening for our 757 Angels Investor Education Series. And tonight's workshop will be on valuation with Bill Payne from the Angel Resource Institute. You'll hear more about him in a moment. This is actually a new thing for us on a couple of levels. Obviously, all of us have gone virtual, so we're getting used to that. We are also doing a lot more education, not only with our own membership, but now with an event such as this, we've really made it a point to open up a lot of our education activities to the larger entrepreneurial ecosystem and community, because we really feel a role and responsibility in these times to make sure that we have a lot of inclusivity and engagement within our community. So tonight's all about valuation. It sounds like such a concrete subject, you know, doesn't it? It sounds very, very concrete. But as many of you may know who have ever experienced valuation from one perspective or another, and certainly I have as well, it is art with science, as I like to think about it. And even in the best of times, it can be contentious, and certainly in times like today, it can actually feel like it's nailing jelly to the wall to be able to come up with an agreement between a founder and an investor. So what's a little bit interesting about it is it's got a particular meaning right now in our times of social and economic change. There's a couple stats Bill will mention earlier, but just to set the tone, there's some national data that show already in the first quarter that angel deals have been down about 25%. The dollars invested have been about 36%. And valuations, again, our topic tonight, have fallen between 20 and 30%. Again, this is all quarter data. But at the same time, as we've learned from past recessions and economic downturns, these times can also be good times to invest. A lot of it depends on the industry. It certainly depends on the fundamentals, financial management and others of the company. And certainly there can be follow-on opportunities, which are certainly another great way to invest that need to be considered as well. So we're very fortunate to have Bill tonight demystify a lot of this for us and really give us not only the tools, but the courage perhaps to keep up the entrepreneurial cadence going on in our region and across the country. So with that, I'd like to turn over to our Executive Director, Monique Adams, to introduce Bill.
Hi, everyone. Thank you so much for joining us. I'm just gonna do a quick introduction of Bill in a moment, but I just wanna welcome everyone. We have a really interesting group of people. About 70% of you all have identified as investors and the rest of you as entrepreneurs. I'm really excited, as Nancy said, to offer this very timely session to help set expectations for our entrepreneurs and assist our investors with making investment decisions. We have, so before we get started, I'd love to give you a couple Zoom guidelines. I know that most of you are Zoom warriors at this point in time and probably don't need a lot of direction, but just bear with me. Since this is a large group, this is a webinar, all of your mics have been muted. We really want to encourage participation. So along the way, we'll be taking some breaks and we'll be asking for your questions at that point in time. We are going to ask you to please use the chat feature to ask your questions. I will be monitoring and moderating the chat, and I will take your questions in random order and I will be asking them to Bill. If you happen to be calling in, we want you to feel free to ask questions as well. Most of the members and the investors have my number. It's 757-513-1343. Feel free to text me your questions and I would be happy to pose the question to Bill as well. Just to set some expectations, the webinar should last about 2 hours. If there's a real robust Q&A session, we might spill over a little bit because we really want to capture your questions and get you some answers. We're also going to send out a survey tomorrow, so please look for that. We'd really appreciate your feedback to this session. So with that, I'm going to introduce our new friend, Bill Payne, who is joining us from Whitefish, Montana. So welcome, Bill.
Thank you.
Yeah, absolutely. We're so honored. And if you were at our last virtual meeting, everybody will already know that I'm a big fan of Bill's. And I would like to provide the group some background on Bill. And as I had mentioned to him before, he has some really amazing credentials, and it probably would take the entire 2 hours to sort of read all of his credits. But Bill is extremely well respected in angel circles, and he's a nationally recognized angel investor. He started out as an engineer. He founded several companies, and he sold one to DuPont. He's invested in over 100 companies, and he's a member of 4 angel groups, and he founded 2. He's served on 16 university boards, and he's been instrumental in forming several entrepreneurial education programs around the country. Honestly, he has way too many awards for me to list here. And he's a published author of The Definitive Guide to Raising Money from Angels. I am so honored to have you here. We are all very lucky to learn from you. Thank you for joining us. I'm going to turn it over to Bill Payne.
Thank you. It's delightful to be with you today. This workshop, as Monique said, is about 2 hours long. We will be stopping frequently, I think 4 times in the middle and then at the end for questions. And it's really, we encourage your questions. It's a lot more fun for us, sort of, as I used to say, at the front of the room. That's not quite the case anymore. But to address your questions, to elaborate on the content that we're about to discuss. This workshop, as you will discover later, is part of a series of 7 workshops that the Angel Capital Association has developed in the last 3 years. These days, they're being delivered mostly virtually as opposed to in-person workshops. A big change, which has required some work on our part to be prepared for them. Nonetheless, it's something that's part of an important part of what Angel Capital Association is doing for their members. So let me jump right in. Please use the chat. That's the easiest way to reach out, and Monique will be monitoring the chat and facilitating our Q&A session. If you have any difficulties, reach out to Monique to help with any problems you may be having with audio or video. I believe you have a copy of the slide deck and the workbook that accompanies this workshop. We will be following the PowerPoint, that's the deck that you have, relatively closely. There may have been a couple of edits at the last minute. So here's what ACA does for its individual and angel group members throughout North America. Probably our most recent activity is gathering, collecting, and reporting on data, investment data from our angel members. And I would refer you to the Angel Funders Report, if you're interested in more information on what's going on generally around the country with respect to angel investing. We are bringing education such as this workshop to our members. Importantly, in about 2008 or 9, we began an effort to provide information to Washington, D.C. on angel investing. It was a time when Congress and the SEC were impacting or had proposed impacting the definition of accredited investor, which would have had a serious negative impact on angel investing in the U.S., and we had to bring that to their attention. Finally, we have lots of meetings, probably more virtual than in person these days, but our summit has been a don't miss for me for many years. So here's what we're going to cover today. Returns on angel investor really drive portfolio strategy, and it's important for both entrepreneurs and angels to understand what our expectations are as investors, because it helps understand the kinds of companies that we're investing in and we aren't investing in, and what kinds of valuations we're expecting. We're also going to cover some nomenclature and then some valuation methodologies, and I'm going to mention and explain specifically the 4 valuation methodologies that are listed there. And because of the recent financial crisis driven by the virus, we'll talk a little bit about the impact that that virus has had, or the financial crisis has had, on angel investing. We don't have a lot of data yet, but we have a little, and I'll tell you what we've got. Finally, we're going to spend the end of the workshop putting the valuation methodologies to work in a case study. I love to do this case study in person. That's not going to be possible today. So we've got a short case for you to read. And then I'm going to use three of the first 3 methods listed here to do this case study exercise for you. Again, we highly encourage you to use your chat function to ask questions at any time. As I mentioned, returns drive our portfolio strategy. So I want to talk out a little bit about what we know about returns to angels investing in startup entrepreneurs. So we have had about 5 published studies that I want to tell you about. Prior to 2007, and personally, I've been investing as an angel since 1980. So a lot of this stuff was very exciting to see when we started getting studies on angel investing. The original work done by Rob Wiltbank was really a seminal work. If you haven't seen this, I highly encourage you to seek out this return study by Wiltbank in 2007. Since then, Wiltbank has done 2 more studies, and very recently in 2008, we've had 2 studies published, one by the Tech Coast Angels in Southern California, and the second by the Central Texas Angel Network, located in Austin, Texas. Now, let me go over the columns for you, just sort of for nomenclature, although we're going to look at that in just a minute as well. ROI, return on investment, is cash on cash, regardless of how long it took for that exit to take place. Hold period is the median time to exit. IRR is internal rate of return, meaning the equivalent interest rate that we have earned on our portfolio of investments. However, the less than 1x means how many companies that we invested in did not return capital. So as you can see, this is a high risk portfolio. The final column is a fraction of our portfolio that returned that 10% of the exits returned 80 to 90% of our upside on angel investing deals. Now, I want to caution you about a couple of things in that past chart. The hold period, or the median time to exit, is useless information to us. Why? Because the only thing happens in the first 2 or 3 years, and I've got some data on this to show you later, is that we see companies fail. So our superb exits, our home runs, happen much later in the process. 6, 8, 10, even 12 years after the time of investment. So the median time to exit is not a particularly useful piece of data for us. Secondly, the 2 circles there. You may have noticed that the Tech Ghost Angels had a very high cash-on-cash return on investment, much higher than the other studies, but that their IRR was sort of right in the range with the rest of the reported studies. And what this means is that the time to exit for the home runs that the Tech Ghost Angels had was longer than the exits that we saw for other groups. So while they had some beautiful home runs, they came at 10, 12, even longer periods of time after the initial investment was made. So we should sort of assume, if we have a significant portfolio, that means a relatively large number of investments, that our return on investment should be about 2.5 times the cash invested, that our internal rate of return should be something over 20% per year, but that our failure rate of invested companies will be greater than 50%, and our home runs as a fraction of the total will be less than 10% of our investments. Now, the only way that we can mitigate the risk of angel investing are utilizing 2 strategies. The first is only to invest in scalable ventures. That means companies that can give us at least a 10 times our money return on investment. And I'm going to fall back on that in just a moment with the next slide. The second is that we have to invest in a lot of companies. Now, this Monte Carlo simulation that the data is reported in this slide was even startling to me when I first saw it. If we make, on average, let's say 6 investments, we will only have a 50-50 chance of getting our capital back. But if we make 12 investments, we've got a 75% probability of seeing the returns of the Wilt Bank study, which was the first one in 2007, which was 2.6x. And if we make 24 investments, we have a likelihood of a 90% probability of getting that 2.6 times our money back. So the information, what we know about returns is they can be excellent, but about half of our companies fail. And as I said, we need to make more than 10 investments, and we can only invest in companies that have a large degree of scalability. That means we believe at the time we invest they have the opportunity to return at least 10 times our money. And let me comment a little more on scalability. We have never been able to discover a relationship between risk and scalability. Now, I've had many entrepreneurs and other angels come to me and say, well, you know, this company only has a chance to give us 2 or 3 or 5 times our return on investment. So that probably means it's a lower risk opportunity. Not the case. From what we know, restaurants have a scalability of probably 2 or 3 times return, and they fail at about the same rate as startup software companies that are funded by angels that have a potential return of 30x or maybe more. So don't fall into the trap of thinking because this is a slow growth company that it has a greater chance of success if you're investing at the seed and startup stage. So let me stop here and see if any of you have posted any questions for Monique or if she has any for me.
Thanks, Bill. Could you go back to the angel return slide
I
and
can do
talk
that.
about, you
This one?
indicated, yeah, that 10% of the portfolio results are in 80 to 90% of, represent 80 to 90% of the returns. Can you expand on that?
Okay, so when we're investing as an angel and we have a significant amount of investments, let's say 10 or 15 or 20 or more companies, and our reserve of capital for these portfolio has been invested, and the returns start flowing in, about it, the 10% of our exits will provide somewhere between 80 and 90% of the upside. So it shows you this particular statistic, and the failure rate in the previous column show you how truly risky this asset class is. And the only way we know to mitigate that risk is to, number one, invest in companies that will scale, and number two, invest in a lot of companies. So what this column again is showing us that 10% or less of our exits are going to give us 80 to 90% of the upside after we get a return of capital. You're muted, Monique.
Sorry, thank you for that. So another question, is the number of years held weighted in any way?
Did you say weighted?
Weighted, yes.
No, that is not weighted. Now, as you'll see, the returns are weighted towards the longer investment times, and I've got some data to show you later on that.
Okay. One other question. Does investing only post-revenue startups help reduce risk?
Well, I think if you think about this a little, the later you invest in companies, and by later, I mean later in their maturity. So if you invest in a pre-revenue company, your risk is higher, but usually your return is higher. If you invest in a company that has $5 or $10 million in revenues, the risk is lower, but probably your upside is also lower. So yes, the lower risk categories are for later stage companies. Now, entrepreneurs need cash at all of those stages, and we angels are one of the few sources of capital that are available at the earliest stages, let's say from proof of concept, meaning they have at least some customers interested in buying it, the product, up to a few $1 million in sales.
Let's do 2 more questions if that's okay, and then we'll move on.
That's fine.
One more question would be, did the studies that you reference include follow-on investments in the study?
It does include a follow-on investment. And as you might imagine, since you're investing in a company that has had previous investment and probably is demonstrating some success, we'd then expect the returns to be a little bit lower, but the risk to also be a little bit lower. So the answer to your question is yes. It includes follow-on and initial investment.
Okay, and this will be the last question before we go on to the next part of your presentation. So how much weight do you place in ensuring a fair price for the investment? For example, a business with a 10 times potential growth paying twice what the company is worth, does that cut the potential in half?
Well, sure. If you think about it, your ROI, your multiple of returns, um, is the denominator is going to be what your initial investment was. And the higher that is, the lower your returns are going to be. So that's one of the reasons that investors are, arm wrestling with entrepreneurs over valuation. And it's not necessarily always a comfortable negotiation, but it's something that we need to do both on the entrepreneur side and the investor side to achieve the investment and the eventual returns that both entrepreneurs and investors alike are looking for. So with that, I'll move on.
Yes, please. Thank
Okay.
you.
So as I mentioned, we're going to talk a little bit about nomenclature. The reason that this is important is just to get us all on the same page. Pre-money valuation is the value of the company negotiated at the time the investment is made. If the investment is obviously clearly the amount of dollars we're putting in the company, and if you add those two together, you get the post-money valuation. Now, one could make a case for the fact that a funded company is worth a lot more than an unfunded company, but this is the nomenclature we use. Pre-money valuation plus investment equals post-money valuation. Now, our percentage of ownership after that investment is made, and this is in the most simple case, would be the investment divided by the post-money valuation. Know that we negotiate pre-money valuation with entrepreneurs, but it is the post-money valuation that determines our return on investment and our percentage of ownership at any stage. So let me give you a quick example of these two formulas. Assuming the pre-money valuation of an entity is $4 million and we're making a $1 million investment, then the post-money valuation would be $5 million, and the percentage of ownership would be 1 million divided by 5 million equals 20%. Now, at the other end of the rainbow, our return on investment is calculated as the exit valuation. That's the price the company sells for, divided by the post-money valuation. Understand now, this is only in the simplest possible case of no subsequent dilution. So any dilution from stock options or subsequent investors changes the nature of our return on investment. When we start talking about pre-money valuation, it's really important to understand that this is not hard and fast. It's not nearly like trying to figure out what the value of your residential or of your residence is when you're at a point where you need to sell your home or buy another home. There really are very few reliable data sets, and there's a lot of negotiation that goes on. An important consideration for everyone is that using multiple valuation methodologies is really important. Please do not depend on any one valuation methodology in preparing to negotiate the valuation of a seed stage deal. Now, as a company matures and begins to get revenues and earnings, there are other methods that are appropriate uh, for valuing enterprises. So almost everything that we're going to talk about today relates to the valuation of startup companies sort of at the cusp of revenues, the not necessarily pre-revenue in that they could be pre-revenue or they could have, let's say, less than $500,000 in annual revenues. I consider both of those to be sort of pre-revenue. They're very, very high risk. However, understand that angel investors do not generally invest in deals that don't have some traction, some market validation. And that could be determined by the willingness of a customer to buy a product, but it also could be determined by prototype or beta testing that customers do that can give the investors an idea of how valuable that product is to potential customers. So let's talk about valuation methodologies. I've categorized 4 different method types here. One is the comparison method, which is really, in the case of the scorecard method, which is a very popular method, it's a real estate analogy. So is your house located in a good school district? Is it a big square footage? Is it in a nice neighborhood? Do you have, granite countertops? The same kind of analogy goes on when we're looking at companies. Another approach is evidenced by work done by Dave Burkus, and we're going to talk about him later in the day, which is a sector analysis where you get a chunk of money for the value of the idea, the success in testing the prototype, etc. The third method is discounting exits. And the most popular and common method used there is a venture capital method, actually devised by Bill Salmon, a professor at Harvard Business School in 1987, revised a couple of times since. I'll actually show you the case number if you want to look that up a bit later. And what Salmon has shown by really observing venture capitalists at work is how they discount those exits back to the present. And the fourth method are calculator methods, which are basically online methods where you answer a series of questions and the data gives you a valuation. And in the case of the Cayenne method, there are 25 different questions. In the case of the Seraph method, which I'm going to discuss in some detail, there are 35 questions. And we're going to use the 4 methods that are in red on this slide in some detail very soon. So discounted cash flow is what most MBAs learn in business school. But what we've discovered is that discounting pro forma financials, which are guesses to begin with, is really arbitrary, is really not particularly useful. So this classic standard discounting of cash flow is not particularly useful for angel investors. So let's talk about the scorecard method, and then we'll stop and see what questions you might have. The scorecard method compares the target company, that's the one we're considering investing in, to recently funded startups in your business sector, in your same geographic area, and of course at the same stage of development. We're looking here at only companies at the seed and startup stage. And you then adjust the median valuation for companies in in your area, in your business sector, based on the strengths and weaknesses of the target company that we're funding. So if you think about this, it's really quite similar to the logic we use in pricing real estate, residential real estate. And frankly, this is probably one of the most popular methods used by angel groups in the US. Of course, one of the harder things about the method is to determine the median valuation that you're going to increase or decrease based on the characteristics of the target company. What I wanted to show you in this curve, in this chart, is how median valuations have changed since the last recession in 2009, increasing more than doubling between 2010 and 2019. I can tell you that the data for 2019 is about $6 million in median valuation. So we saw valuations more than double since the last recession. And we're going to talk more about that later. But we need a starting point. And this is one way, is to use what the national data, but a better idea is to look at your local data. Now, how does pre-money valuation vary with your location? Well, geez, it varies a lot. And you'll notice here that the valuations in New England in 2018 were double the average valuations in the Great Plains state, and 50% higher than in New York. So there can be a significant difference in valuation depending on where you are. So you really have to keep your finger on the pulse of the local markets. Now, what drives these differences? It's clearly a matter of supply and demand. Are there lots of companies looking for money from fewer investors? That's going to drive valuation down. Are there lots of investors looking to invest in fewer companies? Clearly, we'll see valuation increase. So, but for the purpose of this example that I'm about to give you, let's assume that the median valuation of a local company in the same business sector was $5 million at the time we were considering making the investment that I'm going to describe for you. And here's how we weigh the various characteristics of a target company. The management team, we're giving a 30% weighting. The size of the opportunity, as I've already explained, is pretty important. And the product or service is worth less in our weightings than the management team or the size of the opportunity. And I believe this is a big surprise to most entrepreneurs. It surely was to me many years ago. And why is that? That is because we believe that we need to bet, or we have discovered that we need to bet on the jockey, not the horse. So a plus management team can take a C product and make a real success out of the company. A C management team with an A plus product or service probably will not give us a great return. So the quality of the management team is very important to us. And how do we use these weightings? Well, here's a chart for your appraisal. I'm going to complete this chart for you. It's essentially what you saw before, the 6 characteristics on the left and the weightings then on the third column from the right. Now, let me begin to fill out this chart for you. Let's say that we think this is a quality management team. They've got a lot of experience in working together. They've got a lot of experience in this business sector. They may even have had some experience in startup companies before. So we think the weighting of 30% for the management team is low. So we're going to increase that by 50%, giving us an input on the right of 0.45, which we achieve by simply multiplying 30% by 150%. And I'll show you what we're going to do with that, use with that input in just a moment. So if I go ahead and complete this chart, it's an excellent opportunity. I gave that a 140% factor. The product or technology is not quite as far along as we might like it to be from a prototype testing perspective. Proof of concept, I only gave that a 90% factor. Multiplying that times 15%, we get 0.135. Channels, again, a little bit on the weak side, only gave that a 75% factor. This is in a marketplace that has lots of small unfunded competitors, which we love. So we give that a higher weighting. And we believe that to be successful, this company needs international customers, which they haven't yet worked on. So we're marking them down a little there. So if we add up all of those inputs in the right-hand column, we get 1.210. Now, it doesn't take a rocket scientist to figure out that this analysis showed that the target company we're looking at is about 21% stronger than the typical company in this sector, in this region that we're looking at. So if we take our $5 million median valuation and we multiply that by the sum of the inputs in the previous slide, the sum of the right-hand column here, if we multiply that 5 million times 1.21, we get a pre-money valuation of $6.1 million. Now, I'll show you a little bit later how we compare and contrast other methods and what we might use for a starting point for entrepreneurs or for investors in making the investment. So to summarize the scorecard method, we need some historical and current data on the business sector and the local region. It's not a precise valuation method. None of them are, but it's a dependable method that has been utilized for some time by experienced angels and angel groups around the country. And frankly, it's most useful when it's utilized with other valuation methodologies. So with that, let me stop and see what kind of questions you might have that you'd like me to take a shot at answering. Monique?
Hello. Yeah, we have a couple questions. One question was, when determining a cap versus a pre-money, do you use the same valuation methodologies?
Oh, I do. So you're talking about the cap on a convertible note.
Mm-hmm.
It is my opinion that entrepreneurs and investors should use these methods to determine the cap on the note, because the cap on the note should be the valuation of the company today, not at some future time of the conversion of the note or the subsequent investment.
Mm-hmm. These questions are interesting. Okay, next question. How does one gauge the quality of a management team? Can you expand a little bit on your description before?
Actually, we angels need to spend a lot of time talking to the members of the team, especially the entrepreneur, checking references, not necessarily the references that the entrepreneur has given us, but anybody that we can discover who has some information on the background of the entrepreneur and the team. Well, we'd like to, for example, go out to dinner with the entrepreneur, or tour their facility with them, get to know them, to sort of best judge whether this is a team we want to make an investment in or not.
Great. Is there a process, is there a technique or data for understanding the pulse of valuations in a geography?
The networking is the best way that I know to get data in your neighborhood, is to, you know, network with the with other investors who are seed stage investors, and networking with accelerators and incubators, looking at national and regional data. It's not straightforward, and it's best based on utilizing as much experience as possible from others who've been investing in deals in your area.
Okay. What's the criteria used? So you put up a 5 before you applied the factor, I think, of 1.2. So what was the criteria used to determine that $5 million?
The starting point. Yes. And I think that, again, I was depending on the data from the national data when I put $5 million on that slide. I think it's best that you have an understanding of the pricing of deals in your area. So the starting point is, what are other companies being funded at in your area that are in, you know, have somewhat similar business models, or have the similar customer base. It is not a hard and fast number. It's the best number that we can come up with.
Okay, great. So I'm just going to make a comment to the attendees as a whole. We're getting lots of questions on convertible notes versus equity investments and safes. We're going to save those to the end because we're talking here about valuations, if that works for you. I'm trying to reply to you all and let you know. Bill, how do you feel remote investments increasing will change regional valuations, especially given the COVID landscape?
I think it's best for me to say I don't have any idea. As I will show you a little later on, we've got data. We've got a little bit of data on what's happening, probably on a national basis, and a little bit of data from one of our colleagues who in Silicon Valley. But frankly, at this point in time, we're just not far enough in this to know what to expect. We can look at previous financial crises, the 01 dot-com crisis. We can look at the 08 financial crisis and attempt to determine if this financial crisis is similar or not. But we really do not know where valuations are going for sure. We can only guess based on lots of experience and looking at what's happened in the past.
Yeah, and I guess I would add that a recent article said that venture capital is predicting another 40% slide. So whatever that's worth.
Yeah, well, cycle back to that question. One of the things that we don't know about this financial crisis, and I don't want to get into that too much right now, but is this going to be a long, prolonged recovery, or is this basically going to be a V? The market went down fast and the market's going to come up fast. If we look at public sector markets like the Dow Jones or the S&P, it's been a pretty fast recovery. Can we use that data reliably? The answer to your question is we don't know yet.
Mhm. All right, I'm going to pose two more questions, if that's okay.
Fine.
And then we'll move on. Can you explain or can you expand on opportunities further, the way you describe opportunities? The question asks, a startup with a good idea can be viewed as a good opportunity due to low competition, but competition was a separate category. So can you expand there?
So what we're referring to primarily is the size of the opportunity. So if we're dealing with a company that's selling into a marketplace that's $100 million or $200 million, totally saturated, that means that to get a significant level of revenues and therefore get a great exit price, the company has to have 10% market share. So we would much prefer to invest in a company with a much larger opportunity size, $1 billion marketplace or more. Just means that with 1 or 2% market share, this company can be exceedingly valuable. We don't want to invest in companies where the total market size is $10 million. We simply won't have enough upside to justify the investment.
Okay, last question, and then we'll move on. How broadly so there's a lot of geography questions being asked. How broadly do pre-money valuations vary across industry sectors, given similar stages of development for companies in different industries? This participant was surprised at the large variation by region. How about by industry?
So we often hear that valuations in Silicon Valley are much higher than they are elsewhere in the country. And sometimes that's true and sometimes that's not true. By business sector, we don't have a lot of data, but I did run a personal survey of about 50 or 60 investors several years ago. And the outcome was that at the sort of pre-money seed stage company level, the variation was less than I thought it might be. So the low end was software companies. The high end was life science companies. Device companies were sort of in the middle or the high side. But the total variation in valuation was probably 50 or 60%. So the typical valuation of a software company might have been at that in today's market might have been $4 million, whereas a medical device company might be $5.5 or $6 billion. So we're not talking about double or triple at the same stage of development. We're talking about numbers that are less than that, is my experience. Okay,
thanks. Let's forge ahead.
Okay, so the next thing I want to talk about is the Dave Berkus method. And Dave basically assigns a number, a financial valuation for each major factor of risk. Now, Dave Berkus has over 100 investments. He's a founder of the Tech Coast Angels in Southern California. He's been very involved in this asset class for a long time. His method is published, so I highly encourage you to check out the Dave Berkus method. And why do I highly encourage you to do that? Because I changed it. So I have made some modifications in it to bring it current, but I highly encourage you to go back and read his original work. So what Dave does is he takes 6 characteristics. the value of the idea, the prototype, which he considers to be reducing the technology risk, the quality of the team, strategic relationships, including not just partners, but also sales relationships, and finally revenues. And he gives each of those 5 categories a maximum valuation, and in this case, $1.5 million. What the changes that I made were not in the left-hand column, they're in the middle column to bring his methodology current. So it's up to the entrepreneur and the investors to determine where in that range the company, the target company that we're considering investing might be. What is the value of the idea or the team, etc. And I've just completed this by saying that the idea may, the investors decide, be worth $1 million. It's a really good team, so they want to invest in a team. They want to invest in this team, and they think that's worth $1.25 million. The company's a little behind on where they think it might be with respect to revenue, so they wrote that down a little bit to $750,000 and if you sum all of those valuations that, or the adjustments that you've made in valuing the target, you get a sum of $5 million out of a potential of $7.5 million. I'm going to move on before we stop and have questions to talk about the venture capital method, which is widely used in both the angel and the venture communities. So to use this method in the simplified version that I'm going to show you today, first you have to establish a personal anticipated return on investment. And for the example I'm going to show you here, I'm going to suggest that I think we angels deserve 20 times our money back, or an ROI of 20x. That's the easy part. The next thing we have to determine is the terminal value of the target. And that means, what do we think, at what value do we think we can help the entrepreneur sell this company 5 to 10 years into the future? And then we can use Professor Salmon's methodology, which I'll show you in just a moment, to determine the post-money valuation. And we have to subtract from that post-money valuation the investment to get the pre-money valuation, which is what we're always negotiating with entrepreneurs. Now, we know that we're investing in, we know that we're seeking companies that will scale. So for purposes of this study, what I'm going to show you now, we're going to assume a cash return of 20 times our money. Now, oh, sorry, I went backwards. This is the Salmon method, the venture capital method. He determined this by observing venture capitalists at work. This is also highly simplified. Then that is that the return on investment in the nth year, which could be, let's say, 8, the cash on cash return is the value at exit in that year divided by the post-money valuation. Now, that's going to change considerably if there's been lots of investment made since, simply because our interest has been diluted. But for purposes of determining the pre-money valuation in the most simple example, we're going to use this method. Now, how is this useful to us? Well, if you notice the ROI on the left-hand side and the post-money valuation on the right-hand side in the denominator, a simple mathematic transition is to move the post-money valuation to the left side of the equal sign and put the ROI in the denominator. And now we can determine the post-money valuation by determining the exit value in the year of exit, divided by our anticipated return on investment. Remembering again that post-money valuation is the sum of pre-money valuation and investment. So since we know one of the two factors here, that being that our anticipated return on investment is 20x, we now need to determine the terminal value. At what price do we believe we can sell this company 6, 8, 10 years from now? Now, there are several methods of estimating, and I should emphasize we're talking about estimating the terminal value. There's a price earnings ratio method, which I'm going to show you in just a moment. There's a multiple of revenues method, which is actually relatively commonly used in software and internet companies. And then there are other metrics for other verticals. For example, in publications, there might be a multiple of subscriptions, or in the .com area, it might have been a multiple of eyeballs. I would say don't agonize too much over the calculation of terminal value. If you can get within 30% of what you think the valuation might be at exit, you've done a very good job. So let's talk about determining the terminal value by the price earnings ratio. So, and I'm going to use EBITDA and earnings interchangeably here because we're looking at a real estimate of what we think the terminal value might be. So if we believe the revenue projections are reasonable, that in the exit year, the company will have a revenues of whatever we determine them to be. We can look at other companies in this business vertical to determine what their earnings after taxes are. This is a relatively common in a variety of industries to compare earnings as a percentage of revenue among companies. And that's data we can get from public markets. We can also get the price earnings ratio of companies in that sector, which multiplied times the earnings would give us a terminal value. Now you might say, well, using public sector data for earnings after taxes or the price earnings ratio, we know that public companies are usually have less risk and are valued a little bit differently. But the best we can do for this method is to use the data that's available to us for both earnings as a percentage of revenues and price earnings ratio. So let me give you an example. Let's say the investment in a target company is $500,000. The exit year is anticipated to be in the 5th year. We believe the company can achieve $30 million of revenues in the 5th year with a net profit of 15 to 20%, let's say 17%. That would give us net profits in the 5th year of $5.1 million. If this industry typically has a price earnings ratio of 18, multiplying 18 times 5.1 would give us a terminal value, an exit value for this company of $92 million. Pretty valuable little company. So what do we do with that terminal value? Well, if we take that terminal value and divide it by our anticipated return on investment, as I've shown you several slides earlier, the post-money valuation is equal to the terminal value divided by the anticipated ROI. And as I've shown in this slide, the post-money valuation would be $4.6 million, which is 92 million divided by 20, our anticipated ROI. The pre-money valuation is then calculated by subtracting the investment, which was $500,000, from the post-money valuation of 4.6 million, giving us a pre-money valuation of 4.1 million. Now, you can do some additional calculations on the required return, which is 20 times the initial investment of $500,000, or the percentage of the company that you would own at exit, which is $10 million divided by 92, or 10.8 million. But what we're really trying to calculate is the pre-money valuation of $4.1 million. Okay, so a summary of the venture capital method is that we have to have an anticipated ROI of 20x, which we discussed earlier. The venture capital method is oversimplified, but it is a useful method in valuing the enterprises that we're investing in. Okay, so we got 3 results. The scorecard method gave us 6.1. The Dave Berkus method gave us 5.0. The venture capital gave us 4.1 method, 4.1 million. What do we do now? Well, you could probably average them and say, well, maybe 5.0 or 5.1 is an appropriate pre-money valuation for this company. Or if you're entrepreneurs, you might say, well, I know I'm going to get negotiated down towards $5 million, so maybe I ought to start at 6 or 6.5 million and allow myself to get negotiated down to $5 million. If you're at angel investors, on the other hand, you might start at 3.8 or $4 million and allow yourself to be negotiated up to 5. But this method does give you a target, whether you're an entrepreneur or an angel investor, on what an appropriate valuation might be for your enterprise in your region and in your in your business sector. So I'm going to quickly go over the Seraph method. I didn't do an example, but I'm going to tell you about it because I think it's a very useful set of questions that they ask entrepreneurs with respect to this valuation methodology. There are 12. Hello?
I'm sorry, this is Monique. I just, can I interrupt for 1
Sure,
second?
absolutely.
I've gotten a couple reports of attendees that have lost sound. If you've lost sound, please exit the Zoom and try to re-enter. If that doesn't work, send me a text and we'll work with you. Sorry for the interruption.
And you can hear me okay, Monique?
Yes, I can hear you.
Okay.
Fine.
So the Seraph method uses 3 sets of questions related to exit realities, financing requirements, and the current deal environment. And as you can see, there's about an equal number of questions, 12, 12, and 11 in each of those categories. And the methodology that plugs the answers to these questions in into a set of formulas that then gives you an answer on valuation. So there's a spreadsheet for each of these. The total results are then summed, and the assumption made by the Seraph method, which is probably why it's not one of my recommended methods, is that the assumption is that after angels make their first investment, they have a goal of 20 to 30% ownership in the company. And I think this cannot be generalized. I think there are times when angels' money is worth more than 30%. I think there are times when angel money is worth considerably less than 10%. So the assumption that we are forced into a set of formulas that give us a goal of to meet our goal of 20 to 30% ownership doesn't necessarily work for me. So let me just show you what that means. Let's say you've got, looking at the upper right, let's say you've got a great company and you're raising a lot of money, $1.5 million. This, the Serif method would probably give you a pre-money valuation of $9.4 million. If the company is so-so mediocre, but still fundable, raising $1.5 million, they probably would only have a $3.3 million, the green dot in the upper left or in the middle left. Now, if you're raising less money, as you can see, only $500,000 instead of $1.5 million, then the pre-money valuation is going to be lower. So in that case, for a great company, 2.6 million, for a good company, 1.5 million, and for a so-so company, maybe $1 million pre-money valuation. So that's what the formulas that are built into the Serif method give you. Now, while I don't particularly use the Serif method, I must tell you that the set of issues that they've described in those 35 questions are excellent. Even if you don't use the method, I highly encourage you to look the method over to understand what investors are looking for or should be looking for in making investments in portfolio companies. Okay, let's stop now and take a few minutes for questions, and then we'll move on to discussing what's going on in COVID, and then do our case study.
Thanks, Bill. We do have a couple questions. So how does one apply the price earnings ratio to determine the terminal value if the startup is, for example, in a life science company and they don't have any revenue until 3 years or so?
Yes, I think
6 years.
all of these methods are probably not as useful for life science companies, especially the venture capital method, simply because the exit value may be even while the company is pre-revenue. So life science companies are in a different category. And I must say that while we investors are looking for the same thing, that is a quality management team, et cetera, some of these methods don't apply as readily to life science companies as they do to the rest of our portfolio.
Absolutely. And there's also great other sources of multiples like PitchBook and other platforms that allow you to compare and gather data on multiples.
Yes. So the scorecard method remains exceedingly valid in those cases.
Absolutely. Okay. Do any of the valuation methods have more weight than any other? And I think you started to answer that.
I would say that if you use these three methods or even a couple of additional methods, and let me get back to that in just a moment, you'll find that sometimes the Burkett's method is going to give you the highest valuation, or maybe the venture capital method, or maybe the scorecard method. So there's no predicting, in my experience, which of these methodologies is going to give you the high and the low. That's why you need to go through them. I want to also point out that these aren't the only three methods out there. In your workbooks, there's an article that describes 10 different valuation methodologies. I picked these three because I'm very familiar with them, and I think they're at least the most popular methods that angels use, but they aren't the only ones that angels use. So look in your workbooks at the article written by John Houston of the Ohio Tech Angels Fund on various methods, and you'll find out he's described at least 10 of them.
Great. One more or two more questions, if that's okay with you.
Fine.
Great. Where does barriers to entry figure into your valuation?
Did you say barriers to entry?
I did.
Yeah, I think barriers to entry probably has to do with the competitive landscape. So we're talking about selling a product, and I think I would weigh the sales line on the scorecard method, the competition line on multiple methods, um, uh, very carefully when I'm looking to answer the question related to barrier to entry. Frankly, barrier to entry can be a deal killer. So, if any of these numbers, any of these, let's say the scorecard method, of any of the ratings that you come up with were 0, it's probably a deal killer. So it's sort of got to be, 25 to 100% rating for you to even consider investing in the company. So barrier to entry can be a deal killer. It also it can go high or it could go low in the valuation.
And wouldn't you say that barriers to entry is one of the primary considerations in competition in the scorecard method?
Not necessarily. If it's clear, let's say, that IBM is in the target marketplace alongside you, that's that might be a significant negative for investors who say, well, we already know IBM's working on this, and we're anticipating they'll have a product out in 5 or 6 months. Maybe that's a deal killer. So it's not necessarily just barrier to entry. The competitive landscape is pretty important, and we love investing in companies with a big target market, but where the market is divided among a bunch of different companies, many of which we think are sort of underfunded. We'd love to get into competition with them.
Next question. How often do you see, and would you recommend a startup to complete these methods? So from the startup's perspective, would you recommend that they complete these methods themselves before fundraising? And should they share those with the investor?
I think they definitely should use these methods and other methods that John Houston describes in the paper that's in your workbook to try to get as good a handle on what is an appropriate valuation for your enterprise at this stage of development. I wouldn't necessarily share those methods up front, but I would say if you have a valuation that's considerably higher than the investors think it is, and they ask you what methods you used, I think it's actually a plus for you to indicate, well, I've used these 4 different methods to come up with my starting pre-money valuation. At least they know you're not picking a number out of the sky for your valuation. And I think it also, allows everybody to say, well, we think you have your valuation of the management team is too high or too low, depending on which side you're on. So I wouldn't be afraid to share that data. I think if I were an entrepreneur, I would probably wait until the investors ask you how you got to that valuation.
Okay,
And we usually do, incidentally.
Yeah.
Well, how'd you get that valuation?
Next question. from what stage of financing does revenue start mattering?
I think the answer to that question depends on how well the company is doing against their plan. You have a business plan, you're anticipating revenues in 4 months or a year, and you beat the heck out of that number, your value, that's very, very encouraging to both current investors and future investors. On the other hand, if you believe it is clear that you will have, let's say, $1 million of revenues at the end of year one, and you're still pre-revenue, that sort of means to me as an investor that the dogs aren't eating the dog food. In other words, the customers really aren't buying the product, whether it's and it could be anything. It could be the channel you've chosen. It could be the quality of the prototype or beta product that you've put together. Or it could be trouble in manufacturing or bugs you have in the software. So I think meeting the projected and anticipated revenues is probably the best way to assure you are going to have an up round the next time you go out and get money.
Great. Okay, I think we should move on.
Okay, we can do that. So let's talk a little bit about COVID. And this is these are data points that I've found by talking to my colleagues and reading the literature about what we're finding mostly in the first quarter of 2020. I've been investing, as I think I mentioned earlier, since 1980, and in recent memory, there are two major market setbacks: 2001 .com and then the financial crisis of 2008. I've compared data with my colleagues in the angel and VC industries, and we sort of agree that the experienced among us tell their entrepreneurs to preserve capital and focus their resources as investors on companies that are thriving and less so on companies that are marginal, that aren't meeting plan. And while we investors continue to look at new opportunities, but write checks more frequently during financial crises. That's what we've learned from earlier problems in the investor circles. What should we angels expect? What should we do? My perspective is that if we're looking at a follow-on investment, I think it's got to be equally attractive or more attractive than it was in earlier rounds. If they're not meeting their numbers or the market is smaller than they anticipated it might be, I'd be more hesitant to write a follow-on check. I think most of us also say if we have a prolonged financial crisis, funding is going to dry up. So I would suggest that entrepreneurs complete existing rounds that they're raising or raise one more round of capital and raise enough capital and change your business model sufficiently to get to positive cash flow or an exit. If you are anticipating once you achieve a few more milestones and you need to raise a smaller round to get to a big VC round, I think that's problematic. That would be a problem for me because I simply don't know where those big bucks are going to be investing in 6 months. So that would be a concern for me if I was considering a follow-on round in a company that once it had achieved that follow-on round was then going to go for a big investment round. That would be a problem for me. And I think we've already discussed the next couple of insights. Demand remains high, but supply of cash is low. And frankly, we have seen valuations decrease by half or more in previous downturns. Now, what should entrepreneurs do? I think you're probably already aware of this. Slash expenses, extend that runway as far as possible. Look for money from existing investors. Provide a motivation to invest. Decrease your valuation to get your current investors to fill current rounds. Focus on getting to positive cash flow and an exit. And as I mentioned, I don't like investing in deals during financial crisis that need more than one more round to get to at least positive cash flow. Incidentally, let me make a comment about networks versus funds. There are lots of angel networks and lots of angel funds in the US. In networks, we individual angels are writing checks from our own checkbooks. In funds, we have already put that money into the angel fund, and then the fund is making a decision on whether or not it should invest in a company that comes along. From an investor's perspective, that money that I have put into an angel fund is a sunk cost. I know it's going to be invested. I'm not writing another check necessarily. So I think it's a little bit easier to raise money from angel funds rather than angel networks during financial crises. So how do we think the valuations are going to be impacted by COVID-19? And entrepreneurs, I want you to know that we have seen in the past that entrepreneurs are slow to react to a financial crisis. When valuations go down, they're very, very reluctant to decrease their valuation. Wise entrepreneurs and their boards of directors slash valuation quickly to get that money they're trying to raise in the door. If we've got a robust economy that really demonstrates bounce back, I would say this summer, maybe we'll only see valuations down 30%. If by the end of 2020, we haven't seen substantial continuing bounce back, and I think it may be off, valuations might be off as much as 50%. Now, we have encouraging news. From what we know, the economy came back a little bit in the last couple of months. We know that public markets are up. So it is encouraging that we may not be looking at that 50% or more decrease that we've seen in the past, but it's really too early to tell. Okay, so here's a bit of data from colleagues in the marketplace. Jeff Sohl out of the University of New Hampshire reported in May 19th on the first quarter that deals were down 25% and dollars were down 35%. That means that valuations decreased. Same number of deals, but I'm sorry, the dollars decreased more than the number of deals means that the valuation of those deals was lower. He also pointed out that life science deals had done better than others. And as a general rule, that's probably because many of those life science companies were able to pivot or had already been pointed at a solution that would help those suffering from the COVID. So that's why life science deals probably did a little better. Rick Timmons did a survey of those who participate in the Angel Capital Association Angel Funders Report and found that angels were less interested in investing, about 30% of them, in new deals, but they were willing to support portfolio companies. And on new deals, valuations were off as much as 50%. Ron Weissman, who is an active member of the ACA Board of Directors and a member of the Silicon Valley's Band of Angels, reported on a couple of statistics which are sort of startling from Startup Genome, and that 2/3 of startups have less than 6 months cash runway and 40% have less than 3 months runway. That's scary. And about half of Midwestern VCs expected valuations to decrease 20 to 30% in 2020. And I think I mentioned to you earlier that my colleague Dan Rosen up in Seattle pointed out that the valuations of angel deals generally follow, maybe as a leading indicator, but follow public markets. But in neither of those two crises did the market bounce back as quickly as it has in 2020. So that's a little bit of encouraging news, not something we can yet hang our hat on. Okay, let's see if you've got any questions about COVID that I might be able to answer. Certainly not an expert. And then we need to save about 20 minutes, 15 to 20 minutes for the case study exercise.
Okay. Let's start with, if the public markets bounce back quickly, what should we expect from the startup valuations?
Well, this is an issue of emotion. What do I mean by that? Well, angel investors generally invest 10% or less, usually 3 to 10% of their total assets in angel deals. And the rest of those investments are generally made in real estate and public markets. So emotionally, they are very encouraged if markets bounce back rapidly, or very discouraged if markets do not bounce back rapidly. And one of my favorite comparisons is, what does the investor's spouse have to say? If they're really, really nervous about real estate values or the stock market values, and they're not seeing a bounce back, they may put influence on the investor to suggest that investments in this asset class be postponed.
Thanks. Another question, and we see this a lot in the COVID environment. What should angels do when the valuation expectations of the entrepreneurs are out of alignment with those of the investors? So
well, I think we see this all the time, Monique, be it a COVID issue or a times, financial crisis times, or in good times. And it's a matter of doing the best we can in negotiations. If we think the return potential is simply too low because the valuation is too high, then we investors need to walk away. One of the suggestions that we make often to entrepreneurs is, we really like your deal. We think your valuation is too high. We'd like to encourage you to network, get more information on valuation from the local experts who may not be investors, such as managers of incubators and accelerators, and or maybe investors in later stage deals, like local venture capitalists who only look at more mature deals. So gather, encourage the entrepreneur to get more information and see if they can get investment from others. And frankly, I've told entrepreneurs many times, if you can raise money at a higher valuation from other people that I'm willing to invest in, go for it. Good for you. So it's a time to avoid acrimony. But it's a time to make it clear that if you are an investor and the valuation is, in your opinion, outrageous, simply back away and tell the entrepreneur that you do like the deal, and if it were priced in this range, you'd be interested. And if the entrepreneur finds others who are willing to invest in the same range you are, you'd like them to give you another shot.
Absolutely. Next question is a sector related question. So many sectors have actually benefited from COVID: healthcare, work from home, e-com, food. Do you think, and their valuations have actually increased. Do you think that this is a temporary bounce?
Well, I have a couple of examples in my portfolio that are aligned with, let's say, to benefit from the current problems that folks are having with COVID. And I believe the entrepreneurs have raised more money. They have raised more money at higher prices, but it has not been outrageous increases. In other words, between rounds that were maybe 9 months apart, valuations up 20% or some such number, not 200%. So I'd be leery of deals that the company thinks the valuation has increased substantially since last time around, unless their backlog just demonstrates that the demand for this product is realistic and they've got the wherewithal to make and deliver the product.
Mm-hmm. Okay, last question, and then we'll move on. When an entrepreneur asks a very high valuation, doesn't that say something about the founder's character?
Say something about the
founder's character.
I think that's a tough question. I've seen serial entrepreneurs who have demonstrated they can perform, and in their even though I thought the valuation was outrageous, they performed against plan because they had the experience necessary to do so. I've also seen entrepreneurs who look at the other deals that have been done that are not in their area, that are not in their business sector, that are maybe even later stage, saying this deal got priced at $20 million. Therefore, I think that our pre-money valuation should be $20 million. And I just shake my head and say, well, I don't think that's an appropriate valuation, and I'm going to move on and look at the next company. So I don't think it's necessarily a measure of, it could be, but I don't think it's necessarily a measure of character.
Okay. All right, let's move on to the next section or the next topic.
So we're going to do a case study exercise now, and the only way that I know to do this at this point in time is for you to read the following slide or the description of the case, which is the same that's in your workbook. And I'm going to be silent for 3 minutes. And I would like for you to read the case, and then I'm going to go through the 3 different methods for determining the valuation of this enterprise, and then tell you what I would do with those answers at the end. So for the next 3 minutes, please read the following slide, and then we'll start up again, and I'll go through those 3 methods for you. Okay, another 30 seconds. Okay, so let's now see if we can come up with a pre-money valuation for the enterprise described here. So the scorecard method, I typically limit my upper end to 200% or 2.0, and I'm using the starting point of $5 billion, as you can see at the bottom of the slide. So let's appraise the company that we've just read about. Pretty strong management team, at least above average. So maybe 110% for that. Size of the opportunity was okay. Wasn't out of the ballpark, but it's probably pretty good. Product and technology seemed to be pretty good. I gave that 115%. Competitive environment was very strong. gave them 140%. Really only marked them down a little bit in some other factors such as international marketplace, or maybe how far they'd gone in building out a team or facility or whatever might be the case. So now if I multiply the 30% times the 110% for the score for this appraisal of this company, I get a 0.33. If I then do that for the rest of the factors, multiplying the weighting column times the target score column, I get the numbers that you see on the right-hand column. If I add those up, I get 1.07, which means this company is sort of 7 to 10% stronger than some of the other companies that we're looking at. If I multiply that times $5 million, I get 5.35, or let's say $5.4 million. Okay, that's the scorecard method. Now, let's look at the venture capital method. We know that the post-money valuation is the terminal value divided by the return on investment, and we know that our anticipated return on investment is 20. So our terminal value. Now, one of the things back on the terminal value slide is the multiple of revenues for software companies in the terminal year. And so I'm going to use the $60 million and multiply that times 2 to get my terminal value for this particular case. And if I then multiply 60 by 2 and then divide that by 20, I get a pre-money valuation. And if I subtract the investment from that, get the post-money valuation, and I subtract the investment from that post-money valuation, I get to a valuation of $5.5 million. So I've taken the revenues in the terminal year, multiplied them by 2, divided that by 20, which gave me a $6 billion post-money valuation. If I then subtract the investment of $500,000, I get $5.5 million. Okay, now let's look at the Berkens method. And as you can see along the right-hand side, gave them 1 million out of $1.5 million for the idea. The prototype is sort of in the middle. The quality of team was really pretty good. I wasn't really too happy with the strategic relationships or the revenues to date. So it ended up that this company via the Berkes method gave me a $4 billion pre-money valuation. So I now have 5.35, 5 million, and 4 million by the 3 different methods. And so how do I determine what the final number should be? Well, you can average them, or you can throw out an outlier. I might say maybe 4 million is a little low, and it ought to be somewhere between 5.4 and 5.5, something like that. Now, you're also going to have to negotiate a valuation. So I would suggest that angels start low, negotiate towards your number, and entrepreneurs start high and negotiate back towards your number. So the summary for the workshop is that don't depend on TechCrunch and some of the other Silicon Valley publications for the valuation. Understand your ecosystem. I almost never would say this in this workshop, but acknowledge macro market trends like COVID. It's a different world than it was 6 months ago. Please familiarize yourself with multiple methods and then do a deal. Neither we angels nor entrepreneurs can make money and unless we do a deal and build a business. So get the deal done. Okay, that's the end of the workshop, and we'll get back to questions in just a moment. I want to point out that the Angel Capital Association offers actually 7 workshops. The first 4 are pretty fundamental. The next 3 are a little more sophisticated. So just wanted to make you aware of the fact that we had those workshops. And now for the final Q&A period. And for that, I will turn it back to Monique.
Hello. Thank you so much for that. It was really, really interesting. A couple more questions, and then I want to circle back, if you don't mind, to a couple of maybe they're a little more term sheet relative questions on investment vehicle, if you don't mind.
Okay,
sharing your
do
perspective.
my best.
Yeah. So how can we as investors help entrepreneurs to better understand and navigate valuations?
I think the best thing that we can do as angels is educate the influencers of entrepreneurs. So the attorneys and the accountants and the entrepreneurship centers and the incubators and the accelerators, making them aware of what valuation trends are in your region and nationally, both in general and by business sector. So if I were an entrepreneur, I wouldn't necessarily be, paying close attention to what the investors were telling me about valuation, because I know they're on the other side of the table. But if I could find some independent folks without, with expertise, but without a vested interest, such as attorneys, accountants, entrepreneurship centers, etc., I think I would lean on them. So I am suggesting that if there's something angels can do, it's try to bring the awareness of valuation methodologies and the appropriate valuations, increase the awareness in your neighborhood.
Thank you for that. And I'm happy to report that we have a number of those influencers on this webinar. So
Good.
off to a good start.
Oh, I answered the question right then, huh?
Yeah. You so which is the most useful valuation methodology?
I think the most popular and most frequently used is a scorecard method. It's a difficult method because you need a starting point, but I think you're looking at the right factors. And sometimes you can get down in the mud a little bit on the venture capital method of deciding what the appropriate PE ratio or what the appropriate earnings will be in the nth year. So I think the scorecard method is probably the most useful.
Okay. Before we leave valuations, I don't have any other questions on valuation.
Let me make one more, excuse me, let me make one more comment, Monique. I'm sorry for interrupting you. The other thing that I would say about valuation and the usefulness of the methods is look at the Seraph method. I think the questions that are posed of entrepreneurs and investors about an investment opportunity are exactly the right ones. I really like what the guys at Seraph put together in their survey. So excuse me for interrupting. Go ahead.
Absolutely. You're much more important than I am on this webinar. I do want to mention that we are an angel investor network, Bill, so our investors make independent investment decisions. But through our process, our vetting process, we preliminarily start the conversation with the entrepreneurs. And so for all the members and entrepreneurs that are on this call, you all should know that we are starting, so we utilize a couple of these different valuation methodologies to start the conversation and begin the negotiation on valuation, unless we get a deal where the price is set, so it's already sold, and that is a different altogether. Um, if we could just circle back to some of these questions regarding investment vehicles. So what are your thoughts on convertible notes versus equity, cap notes? And if you could also just share your opinion on safes.
Well, let me start with the second question. Actually, not very many investors are using safes, at least not very many sophisticated investors. There are just too many pitfalls, in my opinion, for most of us. So we're much more likely to invest in equity or in convertible debt. Safes emerged, as you know, from the Y Combinator accelerator. And I think it has been adopted by many other accelerators, but not nearly as many angel groups or sophisticated angels are using safes. Let me move on to convertible debt and equity. There are, if an investor invests in convertible debt with no safeguards, such as no cap, and a variety of other terms that are helpful to the investor side, it's high risk investment. In fact, I have seen subsequent investors come along and say, we're going to put money in this company, but you've got to go back to your angel investors and have them forego their interest or change their cap before we'll invest in this deal. It's more risky for angels to invest in convertible debt. That said, convertible debt is very convenient. It's easier. Notes are always easier to, as they say, paper, meaning get the attorneys to create the final documents for them. It's quicker, so there are advantages to convertible debt. My caution to investors and my information for entrepreneurs is that this is not a way for entrepreneurs to get a higher valuation for their enterprise. The cap, the conversion price for the maximum conversion price on the convertible note should be today's valuation. We shouldn't be investing in securities that guarantee lower returns for the investors than we might if we were investing in equity. So the cap should be equal to today's valuation. There are a variety of other terms. For example, I think the best thing that entrepreneurs can do right out of the box when they get angel financing is to ask the angel investors to help them build a really strong board of directors. So perhaps the investors might take one of 5 seats and then help the entrepreneur pick some of the best people in the community to serve on that board of directors. I think boards have tremendous positive influence on both the growth and the exit of entrepreneurs. And notes almost never give note holders any influence over the board of directors or even observer status on those boards. So there are many features of notes that disadvantage investors and, in my opinion, disadvantage entrepreneurs in the long term.
Interesting. So do you feel like those notes where you are with the cap that mirrors the pre-money, then those notes sort of lend themselves to shorter terms as well?
Shorter terms.
18-month term versus a 3-year.
Um, well, I think that if the cap is right, the timing, the conversion is not overwhelmingly relevant. That said, if the entrepreneur plans to raise money in 12 to 18 months and they're 24 months out and they haven't raised any money yet, they're about to run out of money and they want to extend the notes again and again. Stacked notes are things that entrepreneurs don't, in fact, and angels and entrepreneurs don't understand the impact on the cap table. So I really don't like capped notes. I'm sorry, stacked notes. That means a convertible debt, and then when that money is gone, a convertible debt on top of that again and again. 3 or 4 of those, and suddenly you've got a pre-money valuation negotiated on the next round of $7 or $8 million and a post-money of 15 because you've built up so much so much debt that will convert into equity at that next round.
Mm-hmm. All right. Well, I thank you very, very much. I think this has been extremely informative for me, and the feedback has been just pouring in, and it's great. So thank you so much, Bill.
Well, my pleasure, and thank you for inviting me.
Absolutely.
And to you entrepreneurs, I wish you the best. Great luck in your ventures, and you angel investors, go for it.
Thank you. Nancy, do you want to have the last word?
Yeah, the only last word I would say is, Bill, again, we just can't thank you enough. This was really very, very informative, very deep in information, and also motivational at a lot of levels. So thank you so, so much. And I also want to extend a thanks to everybody on this program. Again, we would value your feedback. We appreciate your attendance. And again, thanks to not only our members, but the other participants. So thank you so much. And I hope everybody has a safe and happy evening and future ahead.
Yeah, stay healthy.
Yep.
Bye now.
Goodbye.
Bye.
Good night.